Hi, everyone. Thank you for joining us on K Properties 1031 Exchange DSC Investment Conference Call. My name is Victor Coronado, Associate Vice President here at K Properties. We will begin with risks and disclosures. DST 1031 properties are only available to accredited investors, generally described as having a net worth of over $1 million exclusive of primary residence and accredited entities only, generally described as an entity owned entirely by accredited individuals and or an entity with gross assets of greater than $5 million. If you are unsure if you're an accredited investor and or an accredited entity, please verify with your CPA and attorney. The information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, and or real estate. Such offers are only made through a private placement memorandum, which is solely available to accredited investors and accredited entities. Securities are offered through FNEX Capital, member FINRA and SIPC. FNEX Capital and K Properties are separate entities. This material is not to be interpreted as tax or legal advice. Please speak with your own tax and legal advisors for advice guidance regarding your particular situation. There are risks associated with investing in real estate and Delaware Statutory Trust properties, including but not limited to loss of entire investment principal, declining market values, tenant vacancies, and illiquidity. Investors should read the PPM carefully before investing, paying special attention to the risk section. Because investor situation and objectives vary, this information is not intended to indicate suitability for any particular investor. Please speak with your CPA and attorney to determine if an investment in real estate DSC properties is suitable for your particular situation or circumstance. Past performance is not indicative of future returns. Potential cash flows, returns, appreciation are not guaranteed and could be lower than anticipated. Thank you, everyone, for listening in, and I would like to turn the call over to Senior Vice President Matt McFarland here with K Properties and Investments.
Thank you very much, Victor, for the introduction, and as always, thank you to all of our listeners. We really appreciate you carving out a few minutes of your Friday to tune in to DST Essentials with K Properties. This is a series we've hosted for over 2.5 years now, where we provide in-depth focus on a specific and recurring theme and nuance involved in the real estate 1031 exchange and DST space. So very excited to continue this series today. Before I bring on our guest, I want to give just a little bit of information about K Properties. K Properties is a national DST investment firm. Our platform, www.kpi1031.com, provides access to the marketplace of DSTs. This includes DSTs from over 25 different sponsor companies, custom DSTs only available to K clients, as well as active DST secondary market listings. K Properties team members collectively have over 130 years worth of real estate experience, are licensed in all 30 states, and have participated in over $30 billion worth of DST 1031 investments. I'm very excited to have Steve Haskell on the line with me today. Steve is a Senior Vice President based out of the K Properties San Diego office in Southern California. Steve is both a leader and a specialist in the 1031 DST space and has helped clients purchase over $650 million worth of DST real estate. Steve comes to K Properties and Investments after serving 7 years as an officer in the United States Air Force and Special Operations Community, where he has led small teams as well as large staff of hundreds of military and civilian personnel. He has served in numerous locations around the world, including multiple deployments to Afghanistan and locations throughout Africa. We are very fortunate to have him, and I am very lucky to call him a very good friend of mine. So I'm very excited to have him on the line. Today we're going to be talking about how Delaware Statutory Trusts can help investors in wealth preservation. So we're specifically going to focus on that aspect. So without further ado, Steve, welcome to the call, and thanks for being with us.
Yeah, thanks, Matt. I appreciate the warm introduction. Enjoy doing these calls with you. I think this is it's fun. We get to get into a little more nuanced aspects of DSTs. I find them a little more interesting, and it's always fun to chat with you about it, especially this topic, because as you and I kind of developed in this industry, I think we were coming across legacy planning more and more as being a chief concern of our investors. How are their kids going to inherit it? What are the tax consequences going to be? How do we handle that with, even potential infighting or competing priorities amongst the heirs and the kids? So I think this is a really useful call. I look forward to jumping into it with you.
Likewise. And maybe just to provide a little bit of a backdrop, I want to throw a few statistics out at our listeners. So over the next 20 years, it's estimated that about $84 trillion in assets is set to change hands, which marks arguably or potentially the largest and greatest wealth transfer in the history of our country. And going off what Steve just mentioned, not surprisingly, this is a chief concern of many of our investors, specifically folks who are looking at DSTs as a tool to aid in that estate planning. But in addition to that, real estate is estimated to account for the vast percentage of this wealth too. So you have these different dynamics that are at play, and then enter in the DST structure. So what I want to start with, Steve, maybe even before we get into talking about the DST, maybe it would be helpful for you to talk about this concept of stepped up basis as it relates to real estate in general, and then maybe if you could touch on the 1031 exchange and how it kind of interplays with the stepped up basis. Then we'll kind of dive more into the DSTs, but I think that would be kind of a helpful place to start.
Yeah, sure. So, I mean, primarily when people are coming to us for help, their number one goal is really to defer their taxes. So, and a lot of our clients, as they're getting into retirement or even beyond retirement age, they've accumulated a tremendous amount of wealth in their properties. So the capital gains are pretty significant, and they're potentially going to be even greater going forward with, different legislation coming out, increasing capital gains taxes potentially. Also, you have the biggest one that people don't really think about oftentimes, which is the recapture of the depreciation, which is often, up to 20% or so of everything depreciated. And most of our clients have held their property for a really long time, so they don't have any basis left. So that recapture of depreciation is a big deal. Then on top of that, you got state income, federal income taxes, Obamacare taxes. So, we have clients that are potentially paying between 30 and 40% of their sales price to Uncle Sam. And so their chief concern coming to us is, hey, how do I prevent this? How do I maintain my capital? Well, the 1031 is a great option. Then they say, well, I want to go passive. I don't want to manage this real estate anymore. And say, okay, well, a DST may be a good option for you. And then the next, as the conversation evolves and we're helping our clients and getting to know their concerns and their objectives, oftentimes, especially recently, what pops up is, okay, but what about when my kids inherit it or my heirs inherit it? Are they going to have a huge tax consequence and have to worry about liquidating this real estate and paying taxes in the different states, etc.? And then the nice thing about the DSTs, just like real estate that you own on your own, when the owners pass away, there is a step up in basis. So that means, if the heirs inherited it that year, that day, there's no taxes to be realized at that time, which is great.
Yeah, that's super helpful. And really, in my experience, and I'm sure yours too, Steve, this idea of estate planning and being able to essentially have the family members inherit, these appreciated properties at current market value is really one of the main motivating factors, in all this, right? Certainly, investors are looking to be diversified, hedge their risks, maybe be a little bit more conservative in their orientation and interaction with, their investments. But this is a really, big issue and something that is a huge motivating factor, as I said, for many investors. I thought it'd be helpful maybe to just give a quick example of what this all looks like in terms of what Steve just described. So, of course, this is a hypothetical, but I think this will maybe help illustrate the power of the 1031 exchange and also the reality of this stepped up basis that is available for the heirs that are set to inherit property, whether it's a DST property or it's a property that family owns directly outright. So let's say there's an individual, they purchase an apartment building, 50 years ago for $1 million. They've invested, heavily into this property. They've managed it. They've maintained it well. And fast forward 50 years, that property is now worth $10 million. So if that investor were to sell that property for $10 million, most likely there would be a $10 million capital gain, right? Because likely they've fully depreciated that most of that $1 million down to nothing. And so on the state and federal level, they're going to be taxed at whatever the capital gains rates are. That depreciation recapture tax that, Steve, that you mentioned is going to come into play. And so they would be facing a significant tax liability. Okay.
If it's $10 million, it's going to be the max on every single tax chart. It's going to be capped out. I think income taxes, went up to like 14+% in California. So that's pretty significant.
Very, very significant. So they have, this individual has two options. One, they bite the tax bullet and, they write a check for maybe $4 million to the government, state and federal government, or they can do a 1031 exchange and take that $10 million and reinvest it into like-kind investment property for $10 million and completely defer the capital gains. That investor, let's say they go through with the 1031 exchange, that tax liability is going to continue to follow them throughout their lifetime, right? Now it's deferred, it's not realized gain. But if that piece of property or those properties are ever sold, they're back in the same situation, right? With that capital gain, exposure. When they pass away, that $10 million worth of property, let's say it's worth exactly the same, goes to their kids or their heirs, right? Pursuant to their will and trust. Their heirs, would inherit that property at fair market value. Okay. Fair market value. There's different ways that, that we're not going to comment on specifically that this is determined. People use appraisals and other methods of valuation. But essentially, upon inheriting the property, the heirs inherit it at current market value. So if they were to turn around and sell it the next day for $10 million, there's zero capital gain liability that they have to worry about. Now there may be inheritance tax and other taxes, which isn't something that we specialize in, but it's a very, very powerful tool to transfer wealth generationally in a very tax efficient manner. And the 1031 exchange is really the avenue through which those taxes can be deferred and property can be, eventually passed down, to the lower generations, essentially capital gain tax free. Steve, is there anything you wanted to add on to that?
No, that's really well said. And I think you highlighted all the major points and clarified on some nuances. But I do want to jump into talking about the next step that's usually a chief concern with folks doing their legacy planning, which is using a DST to help a lot of inheritance issues once our clients pass away through fractional ownership.
Yeah, go ahead. Why don't we shift gears and talk more specifically with the DSTs?
All right, great. So I have I've had a lot of situations that I've been exposed to through the years and years that we've been doing this, in which clients have experienced a tremendous amount of stress through family infighting when real estate is inherited, especially when there's multiple heirs that are receiving one piece of real estate. It's very rare that all the heirs want to do the same thing with that property. Usually what I've seen is some people want to manage it, others want to sell it, maybe another wants to fix it up and sell it, and they all have sentimental ties sometimes to it, so which complicates the matter. So in my experience, real estate has been a very difficult asset to bequeath to children especially. So a lot of my clients have pivoted to DSTs as a way to sidestep that problem, because in a DST, you can sell a piece of real estate and 1031 exchange into pieces of different other real estate, and they can divide up their shares however they want. And I'll give you an example. I had a client that sold a property for about $1.6 million recently. And then she had, let me think, I think it was four children. And we said, okay, let's create a portfolio for your family with the expectation that your children will be inheriting this real estate eventually. So we went through a few different options. One was, let's sell the real estate and buy a certain percentage ownership of 4 different properties. So we bought, so she took that 1.5 or so and bought some of a debt-free shopping center in Birmingham, Alabama, then took another percentage and bought a Montessori school in Florida, and then took another chunk, about $400,000 or so, and she put that into a multifamily building, and then in North Carolina, and then took another $400,000. And what did she do with that one? Self-storage facility in Florida. And so she was diversified by asset type, asset class, and geography. And at first she said, well, I'll just give each property to one kid. And I said, well, you can do that, but different assets perform differently at different stages of the real estate cycle. And also they potentially cash flow differently. So the nice thing about the DSTs is you can do 2 things. One, dictate how you want the DSTs to be split up once they're bequeathed to the heirs, and then you put that in the will. And 2, you can do what's called a time of death form, which you submit to the sponsor that tells them what to do with the money and information in the account for that investment. And you can tell them however to manage the proceeds. So what we did was we figured we would still do 4 different investments from the sale of that one piece of property so that my client's still diversified. However, she's going to go to her will, and upon her and her husband's passing, she will instruct each DST to be split up in 4 different ways. And typically, these are planning to sell in 5 to 7 years, and they're probably going to sell at different times. So the way she wants to do it is she wants to set it up so once her husband and her pass away, as each DST sells, then the money will be split into 4 different directions going to the 4 different kids, and that's already pre-planned and established ahead of time. And it's also great, not her, but I have another client that did the same thing, but they were really excited about this because they set it up that the kids couldn't touch the principal until the DST sells to give them a bit of a cooling off period. Because one of my clients had one of their heirs that they weren't super optimistic about what they would do with the money right away. So they said, this heir needs a cooling off period. So if we pass away and there's a couple years of letting the DST provide them income, then the money will be distributed a couple years later, and then the next DST a couple years after that, and so on and so forth. It'll allow them to gradually take the income over time and hopefully increase the chances of managing it more competently. Anyways, just a little anecdote that I thought was interesting.
That is really interesting. I appreciate you sharing that. I think the examples are just so powerful when explaining some of these concepts. I like to describe, the DST liquidation as almost a staircase liquidity event for an estate, because as you so clearly stated, Steve, not all these DSTs are going to sell at the same time in the same year. So for folks that are kind of trying to create that naturally will most likely come into effect with most DSTs that have more of a traditional exit strategy. And what I mean by a traditional exit strategy is a DST that goes through its ordinary business plan. The property is held, invested into for a period of 5, 7, 8 years, and then it's just sold on the open market, just like any other piece of real estate, to an unrelated third party. That sale would trigger the liquidity event in which each of the investors would be entitled to their pro rata portion of the net cash proceeds that are generated from the sale. And in that process, that's when, going back to Steve's examples, that's when it would be divvied up and paid proportionately to the different heirs. So that's kind of number one. I also wanted to quickly mention another potential exit strategy that we're seeing, I'd say, become more and more prominent in the DST world is the 721 exchange exit option. And this is really interesting because instead of DSTs being kind of a natural staircase, liquidity and a traditional sell-off, this almost puts a little bit more control in the hands of the estate to control the liquidity for themselves, or at least the potential to control is there more so than the traditional, DST exit scenario. And so very quickly with the 721, the DST is absorbed into a much larger fund or REIT, tax deferred once again through a 721 exchange. And the thought is that 721 vehicle, whether it's a fund or REIT, will be able to offer the owner, whether it's that original owner or their estate, after they pass away, the ability to request liquidity, within a certain period of time. So the thought there is, the original owner purchases the DST through the 1031 exchange. They own the DST for a set period of time. That DST is brought into this larger fund or REIT tax deferred through the 721. That investor continues to own interest in the 721 exchange vehicle, receive the same kind of monthly or quarterly payouts. They pass away, the estate is entitled to the same step up that they would owning a DST or owning another piece of property, and then would get to kind of control their exit a little bit more. I'm not going to get into too many of the details, but both of those are interesting in different ways when we're talking about this concept of estate planning, really more so from a liquidity standpoint after that hypothetical step up is realized.
There you go. And of course, we're around, everybody, if you're interested in digging more into the 721 UPREIT strategy and its potential benefits and risks. We're all, the K Properties team is here to walk you through it. It's not for everybody, but it can be a great tool for legacy planning.
Definitely. Wonderful. Well, Steve, I really appreciate your time as always and all the great information you shared with us. And To our listeners, we really appreciate your time as well. Thanks for tuning in this Friday. We do host this call live every Friday, so I invite you to join us next Friday at 11 o'clock Pacific. And for those of you that are newer to K Properties, we also do host a Wednesday webinar. So we'd invite you to join that as well. With that, I wish everyone a wonderful rest of your Friday and a great weekend ahead. We look forward to speaking to each and every one of you very soon. Thanks, everyone, and take care.